founders need to think about valuation not as a success metric. They need to think of it as an obligation. You now have an obligation to get to this point. So
Mhm.
if you say you have $1 million in revenue and I'm giving you a $10 million valuation today, that means that you have to live up to a $10 million valuation, which really means like your revenue has to kind of catch up.
Yuri Navarro, thank you for talking with us today. You are a venture capitalist, so you can provide a different lens on the startup environment. And I'm looking forward to understanding a little bit about who you are and what you do, and maybe what a startup founder should consider when they're looking for funding. Could we start with what is a venture capitalist and how does one become a venture capitalist?
That's a good question. So I can define a venture capitalist quite clearly. I think becoming a venture capitalist is maybe a little bit trickier, and I'll get into that a little bit as well. Um, I don't know if I'm the best person to explain that, just because like I find my path is a little bit off the beaten path, but also I think a lot of venture capitalists are like that. Venture capital is an asset class within the capital stack. So if you think of the capital stack, obviously everybody knows banks. Banks lend money to individuals, personal loans. They lend money for property, like you want to buy a car, you want to buy a house, and sometimes they lend money to businesses. But usually when they lend money to businesses, they like to see like an established business with like stable revenues, and like they're always kind of trying to measure ability to pay. So for better or worse, while a bank can lend money to businesses, oftentimes it is only really suitable for situations where the business is well established and has 5 to 10 years of revenue runway, and like the bank can basically run their formulas on that. You know, outside of the banks, there's a number of other points in the capital stack that range in kind of strategy and also risk and return profile. So, a lot of people might know about private equity. Oftentimes, that's large capital where they will come in, usually to take a controlling stake in a company. And if they try to identify companies that are inefficient, and they think they can run better. But those are like almost like acquisitions. There's also like in the capital stack, there's also like venture debt lenders, where like if you have a fast growing company, they'll lend you some debt and collateralize that, and get you to pay back at high interest rates. So again, like as you go down the stack, there's like more risk means more cost. Usually that's interest rate, and usually they're trying to collateralize it against something. And so there's a whole kind of spectrum, and like I'll let people kind of research this on their own time. But right at the bottom of the spectrum, at the highest possible risk, is what you would call venture capital. And venture capital is essentially um, also, essentially a level on the stack where you're essentially talking about money managers. You're not talking about people that are investing their own money for the most part. There are people that do that with their own money. Those are called usually family offices. So you have like a wealthy family office. Sometimes they'll invest in tech, but they're using their own money. Um, in the venture capital world, yes, you have is like partners. Often there's like a general partner or a managing partner that will be part of the team, and those partners will come in and essentially um, put in a little bit of their own money, but ultimately find other investors that believe in their vision, what they call like a thesis for the fund, and that thesis usually lays out the things that you will invest in, the things that you won't invest in, and your strategy for how you're going to make money. But ultimately, you're raising money from these other people that believe in your thesis, believe in your team, and are essentially committing to you on a usually 10-year basis, to go out there and invest their money and return a return that is a consummate of like the risk, right? And so like the whole point here is that these transactions tend to be very high risk, and because they're very high risk, the return has to be equivalently high return. And so we're not talking about taking a loan from a bank at 10% interest. We're not talking about taking venture debt at like 18% interest or 15% interest, whatever it might be these days. About is the venture capital investor is often looking for about a 10 to 20 times their money return on the investment that they make into a startup. And the reason for that is that there's often no collateral. There's very little more than a business strategy, a team. Maybe there's an MVP. More and more venture capitalists are liking to see businesses where they have some revenue and some traction with customers. But what they're looking for are high growth businesses because, as I mentioned earlier, 10 years is the horizon of these funds typically. There's some nuance there. They can sometimes extend a little bit further if there's a really interesting company that they want to stay in for a little bit longer. But ultimately, what they're trying to do is deploy that capital within the first 1 to 4 years of the fund typically, and then return that capital to their investors within the 7 to 10 years of the fund. So that means that if you're a company taking money from a venture capital, the implicit expectation is that whatever money you take, you're expected to return to that venture capitalist 10 to 20 times the money that they gave you in about 5 to 7 years. And that's something that like oftentimes companies miss. And there's it's really important to have alignment of interest. And I find that like this is sometimes where alignment of interest can kind of go off the rails, because if it's not an explicit alignment of interest on that strategy, I mean, let's just say that building a company to the point where they can generate that kind of return in that kind of timeline is not easy. It doesn't oftentimes take into consideration as much as you would maybe otherwise do things like sustainability, profitability. Oftentimes what you're after is high growth rate in a big enough market. And so, venture capitalists have all these formulas. They're great at creating formulas. The average venture capitalist probably sees between, 500 on the low end to about 2,000 companies a year that they, will pitch to them that will, they'll look at. And so in order to process that much information, they often will develop frameworks. And so those frameworks are looking for things like what's the size of the market, what's the speed at which this company has been growing and has the potential to grow. What is the business strategy? Do we believe in it? How de-risked or validated is the technology? How de-risked or validated is the customer fit? Because it takes time to figure that out. But the idea is that you have a big enough opportunity in terms of the market, you have a competitive enough solution in terms of the technology or product that you're selling, that not only do you have the potential to capture a huge market, but you have the potential to do that at a really rapid scale once you can hit that product market fit. And so that's ultimately what venture capitalists are looking for. Yeah, I mean, like it's a complex business because ultimately the typical model is that the venture capitalists will agree with their limited partners, which are the people that give them money, on again very specific thing criteria. What industries are we investing? What stage are we investing? What checks are we investing? Like how many checks? The size of those checks? Any red flags? Any things that we're not investing in? So like explicit call outs for usually things like we're not investing in these kinds of industries, or we won't invest in anything that's hardware, or we won't invest in anything that's not in North America is actually quite a common thing, especially if you're taking institutional money. Institutional investors are another part of the capital stack, but that sit way above venture capital and often feed the venture capital funds. And those institutional investors, invest globally. And so, they're not giving you as a venture capitalist money to go and invest in whatever you want in any market because they have buckets. They have the venture capital bucket, they have the private equity bucket, they have the banking bucket. And what they're trying to do is kind of understand how they manage those buckets between them and reduce the amount of overlap between those buckets. And so, oftentimes, the limited partners are the ones that tell the venture capitalists, hey, you can't invest in a company coming out of Japan, or you can't invest in a company coming out of Europe because you're my North American fund. I have another Japanese fund or European fund that invests in European deals, so don't get it mixed up. And then oftentimes that's the same thing on the technology or the stage of company, et cetera, et cetera. And so, you have pretty clear guardrails as a venture capitalist in terms of like what you're looking for, how you're supposed to execute, and the goal is to return at the end of the day on a portfolio of companies, at least four times. Realistically, 4 times doesn't get anybody that excited. What you're really looking for is probably above 5 times return on the fund to the investors in the fund. And this is why you need 20 times returns, because the data will say that this is such a high risk game that most of the deals that you invest in will actually end up going to zero. I think the statistics tend to be, if you look at a big enough data set over a long enough period, it's somewhere around like one standard deviation of like all the deals that you invest in are going to go to zero. And then like, within two standard deviations, if you have a big enough portfolio, you're going to get a bunch of companies that go to, maybe return the capital to you, maybe give you a meager return. But those businesses really don't move the needle, because if you have 60-70% of your portfolio going to zero, it's not enough for the other 30% of your portfolio to give you back your capital or even give you like a 4 or 5 times return. That's not going to give your fund a 4 or 5 times return. You need those deals to hit, a 20 times return, or even better, 50, 100 times return. Those are the kinds of returns that then are capable of returning your whole fund. And this is ultimately what venture capitalists are after, because they need to, on the few deals that really hit it out of the park, they need those deals to hit it out of the park so well that their fund hits it out of the park. So there's a lot of weight on the backs of the founders that take money from venture capitalists to actually, execute at a magnificent scale that, for a lot of people seems unheard of. Um, and and so it's really important to understand that interest alignment.
So it's ultra high performers already that would be looking for venture capital money or receiving venture capital money. And even at that level, there's only one gold medal. And it seems like maybe, I mean, I've heard 1 out of 10 perhaps hit the levels that you're looking for and carrying the rest of the fund, so to speak. I've heard that there's pros and cons with venture capital. You painted a nice realistic picture there of what to expect or what your responsibility should be on the part of the founder or the borrower. But I assume there's a lot that you gain beyond monetary injection, like an injection of capital, because like yourself, you have a lot of experience, you have a network, and I'm sure that you want the company to succeed as well. So, what is the line of communication between the founder and the venture capitalist?
So let me just say that a couple of things there. So, what can you expect from a venture capital fund? Like, I'll just start by saying that like all venture capital funds have a strategy that involves some kind of differentiation that they see. So, I sometimes facetiously joke that the typical venture capitalist has the same strategy as every other venture capitalist, which essentially entails I'm smarter than everybody else, so I'm going to be able to return 10 times your money. It's a bit facetious when I say that, but actually implicitly that's essentially what they're saying. There's the strategies don't differentiate that much. It's like I'm smarter, I'm going to be able to find better deals than everybody else. I'm smarter, I'm going to be able to help the companies succeed more than everybody else. I'm smarter, I'm going to be able to get into the deals that are the ones that will turn into unicorns down the road, better than everybody else. There are some companies like my own and a few others that try to kind of differentiate beyond just the I'm smarter or I'm better. But like a lot of it is realistically that. And sometimes those people are right and sometimes those people are wrong. If you look at the return profile of venture capital firms themselves, it's very similar to the return profiles of the companies inside the venture capital firms. So you have the vast majority of them that don't manage to return the capital to their investors, and you have a significant portion of them that, maybe return the capital, but don't really make a return that is meaningful to the investors. And then you have like a small sliver, in the grand scheme of things, of funds that are able to consistently generate, 20, 30 times returns or more in some cases. And those are the ones that everybody wants to give money to. But of course, they have limited money that they can take as well. So then that's kind of the game, right? Like the LPs are constantly hunting how to find the next 30x venture capital fund. And sometimes that requires building a relationship. Now, what I will say is that, in terms of actually executing on that value proposition is very difficult. And it depends on the strategy of it. So, the venture math will tell you that the bigger the portfolio you build, the more de-risked your portfolio becomes. This is just typical portfolio theory for anybody who studied portfolio theory. But essentially, if you have more than 20 companies, you have a pretty good chance of being able to return the capital at least. If you have like 40, you have an even better chance. If you have over 100, you have a fantastic chance of being able to return the capital at least. But you have less, as that goes up, you have less of a chance of being able to be one of those 10, 20 times, 40 times funds, because you're also diversifying away the returns. So it's kind of an interesting dynamic there. The other thing that happens is that, venture capital funds have a really interesting economic model where, the return to the investment team is mainly predicated on the outcome of the fund itself. So usually this is what we call the 2 and 20 model. Basically means that the way a venture capitalist makes money is by returning a fantastic return to their original investors, and then their original investors share 20% of that return with the investment team. This is how it works. Typically speaking, there are variations on that, but that's typically what you're talking about. The two is the operating cost. So usually funds will be able to collect something like 2% a year, for the life of the fund, which is again usually 10 years, um, for operating costs. So this means paying salaries, paying any software licenses, the office, travel costs, everything that the fund needs to live on has to come out of that 2%. And oftentimes there's even restrictions on the fund from doing anything else outside of that 2% to generate revenue, because that is seen as a distraction by the limited partners. And so they limit the managing team from getting distracted on other things to raise capital. What it basically means is that you have very limited resources. Like, unless if you're $1 billion fund, you have very limited resources that you can actually use to run your business. And so the bigger the portfolio, the harder that is to do. So if you have 100 companies or 50 companies, you now have 50 companies that you have to manage, that you have to add value to, and how exactly do you do that? If you have a smaller fund like 10 companies, it's easier to try to be involved and be working together with the company. But then essentially you have to be really, really good at picking companies, because unless if you're really, really good at picking companies and getting into those deals, you could spend all your time working on 10 companies that end up not returning the fund. Not some, and that's not necessarily on the founder too. Like, just so you understand, like, there's so many things that could happen, right? Like, the economy could change, the market could change, the customer could change. There's always pivots in these kinds of businesses, and so it's really hard to predict accurately. I think most venture capitalists that have a lot of experience will say, they almost never knew when they made the investment which were the companies that were going to generate those big returns and which were the companies that were going to fail. Usually there's like an inverse relationship there, where the ones that they thought were going to be the big success stories ended up failing, and the ones that they kind of flippantly made an investment into, and said, like, let's hope for the best, those are the ones that end up actually generating the return. And so, like, it's just really hard. So it's not an easy business. It's a business where you're committed for 10 years, and it's a business where it's a lot of work and you're getting underpaid, unless if you can return that, 20, 30 times return on the fund. And so, I'm just saying that to say, manage expectations, that oftentimes venture capitalists go in with the right intentions. They go in saying, like, hey, I'm going to add all this value. And then in the reality, when they get into it, they can't. Like they just don't have the bandwidth, they don't have the time, they don't have the staff. And so actually adding that value is difficult. And this is why sometimes founders and, have a bad opinion of their venture capitalists. I mean, there are such thing as bad venture capitalists as well, but usually that kind of relationship comes from just the fact that venture capitalist has to prioritize. And if you're not looking like one of the companies that's capable of generating 20, to 40 times return within the first couple of years of them engaging with you, they're going to pretty much write you off and like put a big fat X on your company, and then focus on the ones that actually look like they might generate that kind of return. And so it's just like prioritization. That's really what it comes down to. Now, what are those value benefits? Yes, more money. So first of all, most VCs these days have a strategy that isn't like, I'm going to come in, give you a bunch of money today, and then hope for the best. Most of them have a strategy now. They've learned over the years that it makes sense to double down. And so, they'll give you a little bit of money up front, reserve a bunch of money for later. And if you do the things you say you're going to do and you execute and you look like one of those companies that could hit 20 times, then they'll come back in later and give you more money at the next round. And that's really critical because that's a signal to the market. If your previous investors aren't backing you on your next round, you're going to have a really hard time raising capital, because everybody's going to say, what do they know that we don't know? And
Right.
why is it that nobody in their original investor group is willing to back this company anymore? So that's something to understand. The other side of it is connections. So hopefully, the people who are running the venture capital team are well connected and well respected in the ecosystem, which means that they can open doors for you that you can't. That could be with investors, that could be with partners, that could be with customers. Sometimes it can even have to do with other things like helping you with, for example, in our case, we sometimes help companies with immigration. We help some companies engage with their enterprise customers. These are things that you can do, and every fund again is different. Sometimes it could be having access to the top minds in a field. So, like somebody like Andreessen, who has a huge team, can hire the brightest minds and bring them into the fund. And now part of the value proposition of taking money from them is that you get access to these great minds, right? And they'll put one of those on your advisory board or whatever. And so this is often another way that they differentiate. And then beyond that, it's like honestly keeping you accountable. This oftentimes companies don't realize when they get into the relationship with the venture capital that they are jumping on a treadmill, or like maybe it's like a mouse wheel, right? And it's a mouse wheel, and the venture capitalist there is there to crack the whip. So keep you accountable, keep you focused on the goals, keep you moving. Don't let you kind of like relax. Don't let you kind of ease off the target. Make sure you're hitting the targets that you commit to. Make sure you're thinking big enough and being ambitious enough. And that is sometimes really annoying for a founder. Can lead to a toxic relationship in the worst case. But frankly, if you're going to hit the kind of revenue multiples that they're hoping for in the time span that you're hoping for, you need somebody pushing you. And so this is the one of the key value kind of areas that venture capitalists can add.
Well, you already answered my next question because I was going to ask. Mentioned sometimes people encourage you not to go the venture capital route if it might not be a good fit for your personality type or the way that you might want to run your business. Because I could say, oh, yeah, I think this will be successful, but you have a lot more data than I do. And it's like, is this a 20 to 30x type of business plan, or is this a 1 to 3x type of business plan, which is fine. I mean, that would suit some people just fine, but it's important, I think, to understand what is venture capital and why you might want to and why you might not want to pursue that route.
Yeah, and on that front, like to be honest, like there's other options within even the venture stage, right? Like it's not only venture capital that you have to go after. This is how venture capital works. There are angel investors. I mentioned family offices before. Oftentimes, the objectives differ drastically with these kinds of investors. Like an angel investor is investing their own money. Oftentimes if you return 5 times their money, they're going to be quite happy. And yes, they would love to have that money back earlier the better. But like at at the same time, if you need a couple more years to be able to kind of generate an IPO or an acquisition or whatever, they can be patient with that capital because it's their capital. They don't have anybody breathing down their necks telling them they have to return the money,
Hmm.
right? And so like this is a key factor. There are other options even in the technology venture stack of capital. There are other options that might be a better fit and might better align with your goals as a founder. And so, like one of the important things that I often try to kind of have companies do when they're thinking through this process is like actually focus in on, hey, what kind of a company are you? What kind of a business do you have? What is realistic for you to achieve, within 5 to 10 years in terms of revenue growth? Are you going to get to 100 million? Like usually 100 million is that magic number that venture capitalists are looking for. In 5 to 7 years, can you hit 100 million or more in revenue? The reason they look for that is, typically, especially these days, the market is paying around 10 times multiple on a fast growing technology company. If you're fast growing and you have an interesting business that could grow even faster, and you're going to either IPO or you're going to get acquired, 10 times is kind of what the market pays. So, if you're $100 million in revenue, it means you're worth $1 billion, like something like that. It's not exactly, rocket science in terms of that math. Like there's a lot of subjectivity to it, but like that's kind of the multiples you have to hit. So if you're not thinking you're the kind of business that can get to $100 million in revenue, with the potential for a multi-billion-dollar, like at least $5 to $10 billion in potential market size, and that you don't think you can do that in 5 to 7 years, then don't go the venture capital route. Like that's the reality. Don't, because it's not for you, right? And
Yeah.
there are other options. And even like if you have a great business, like there's some great businesses out there that have assets. Like go get a bank loan. It's cheaper. Equity financing is expensive, right? It's the most expensive kind of money there is. And so, go out and get a bank loan, if you can get it, or, go out and get, any other number of options you have, grants, export financing. There's just so many things, so many options out there to help you build your business. You know, not everybody has to go after venture capital.
Noted. What is your thesis?
So our thesis to Canada Ventures, is that because of everything that I kind of explained about the way the venture capital market is laid out, there is a gap essentially in the market, for companies that are coming into North America from other markets, especially if they're coming from emerging markets. So personally, we feel strongly that immigrants add a lot of value, to not only the country when they come in, but also the ecosystem of entrepreneurship. If you're uprooting your life to basically move to a new country to execute a new business, you have an incredible risk tolerance, just to begin with. And then on top of that, you are very ambitious to be able to kind of uproot your whole life and do that. So those are
Yeah.
characteristics that you're looking for often in a founder. Beyond that, if you are building your company in an emerging market, depending on the market, some markets are earlier than others, some markets are more developed than others. We try to look for companies in markets that we feel are like 5 to 10 years behind where Canada is in its development. We feel that Canada is probably 5 to 10 years behind in its development where Silicon Valley is today, and some of the larger U.S. markets. Um, and what we're trying to do is kind of act as a bridge for that company. If that company knows that they need to go to the U.S. market to sell, they need to go eventually to raise there as well, in order to accelerate growth. We use Canada and the U.S. as well, but mainly Canada as a bridge to help the companies kind of step into that North American market, and help de-risk that process of doing that, and then also accelerate the traction side. Because the reality is, because of everything that I explained about the venture capital market, it's not so easy. Like you can't just set up a North American entity like a Delaware Corp and be like, hey, I'm a North American company now, give me money. It doesn't work that way. So like, there's a whole
Mm.
process. You have to come in, you have to be here. You have to, some of your senior leadership founders have to be here. They have to build the relationships with investors and customers. They have to show that they can sell to the customers. Sometimes that requires a pivot in your entry point into the market, in the strategy of how you acquire customers, because the customers here might be different and have different needs than the customers in your home market. But like once you get to the point where you're restructured as a parent company in North America, where all the assets are here, because investors won't invest unless if all the assets are in the entity where they're investing in. And as I mentioned before, most investors are restricted by their own investors to invest in companies that are not primarily domiciled in their home market. Sometimes that's North America, sometimes that's specifically Canada or like a province. If you've taken money, for example, from a provincial government, there's usually restrictions that say you have to invest in Alberta or Ontario or Quebec. And so, like, these are all considerations that essentially create blind spots in the market, where there's fantastic companies with fantastic solutions. We think the talent in terms of like being able to build a company, code, build technology, identify opportunities, that talent we feel is global. And so the issue isn't access to talent or ideas. The issue is actually access to markets in terms of customers and capital. And so what we're looking for are companies that are selling to enterprise, mainly because 50% of the Fortune 500 companies are based out of North America. So if you're selling to enterprise, you're probably needing to sell in North America at some point. Um, and then, of course, if you're wanting to access risk capital here, then that's also part of it too. But we start on the customer side, because if you can't get the customer side down, you're not going to get the investment side down. And then the question is, can you scale? And so, if you're coming from an emerging market, most of those emerging markets, have interesting technology companies, but don't have the capital, right? It's just like there's not as many funds, there's not as many angels, the check sizes are smaller, the valuations are smaller. And so, you're probably growing the company more sustainably. You're thinking about things like profitability and revenue early on. You're growing yourself from your own revenues. That's fantastic. We love those kinds of businesses. But the reality is, to be successful in this market, can you accelerate to the point that if you take capital from a venture capital investor, you can go to 5, 10 times, in return in the first few years? Can you get to the
Mm.
point where you get to 100 million in revenue within 5 to 7 years of landing in this market? That's the key question we're trying to answer. Because if you can't do that, then we won't be able to find you follow-on investors, and you won't be able to kind of execute, and then kind of like it's all for naught to some extent. So this is essentially what our thesis is.
A few years back, I read about a Corvette V8 engine that used some engineering to basically only use 4 cylinders for gas efficiency, fuel efficiency. And then when you floored it, you'd have all 8 cylinders and you could really race. And so it sounds like you're looking for something like that. Like when they get the capital injection, they can really get those 20 to 30x returns that you're looking for in this market.
Yeah, and it depends on their positioning in the market. It depends on their go-to-market strategy. It depends on the type of solution or technology that they have. There's a number of factors that go into it. Some businesses are fantastic businesses, but they're not venture scale businesses. And so like oftentimes I'll try to help companies anyways. Like if they're, I'm an immigrant myself. I'm doing this because I think there's an opportunity to generate a differentiated return in this market, doing this, but I'm also doing it because I love to help founders. I love to help immigrants, especially. And I believe that in doing so, we're going to generate good for the ecosystem. Like it's not just the return; it's the entire ecosystem will benefit from this. And I would love to see Canada become more of a top of mind destination for founders trying to come into North America. So I see this as a rising tide that floats all boats. And so I'm always happy to talk to a founder, give them advice. If it's not a fit for us, we'll happily send them to somewhere else where it could be a fit. But yeah, we're looking for venture scale returns ourselves. Yeah.
Okay. And you are involved with the Creative Destruction Lab, I understand. Could you talk a little bit about what your involvement is?
Yeah, so I'm a mentor at a couple of actually incubators. So Creative Destruction Lab is one where I'm a mentor. It's funny, I've been mentor there on and off over the years. So like at one point in time, I used to be one of the original team at Panache Ventures, which is another fund here in Canada. And so I spent some time mentoring companies back then. I also used to run the National Angel Capital Organization, which is kind of like the industry organization for early stage. So everything from venture capital funds that are early, so like pre-seed venture capital funds, accelerators, angel investors, family offices, all that kind of stuff. And so back then I used to mentor a little bit at Creative Destruction Lab as well. So on and off, I've been involved, quite a bit now as Canada Ventures. I'm also a mentor. I just rejoined again this year as a mentor at CDL, partly because we ended up investing in a company that went through CDL, and we're working quite intensely with them, and CDL itself has been expanding into new markets. So like whereas CDL started something out of the University of Toronto that was very Toronto centric, they then expanded to Atlantic Canada, Western Canada, and they went right across Canada. Now they've expanded into chapters in the US, in Europe, even in Asia. And so they're starting themselves to see way more companies coming in from all over the world. It aligns with what we're doing. We love to help foreign founders, and so I've been kind of mentoring with them. I would say like CDL is often recognized as the premier kind of tech incubator slash accelerator. It's kind of like somewhere in the middle, I would characterize it as. But it's very focused on like on real technology, hard technology, um, and helping companies kind of execute, at the earliest stages of their technology development, getting them to a point where they can raise capital, where they can get their first customers, get their prototypes out, that kind of thing. I'm also involved with another accelerator called Venture Lab, which is very much focused in on what they call hard tech, which is real deep tech and hardware, and the combination and interaction of those two things. So, things like semiconductors, microelectronics, med tech devices, digital health, AI applications, or AI, more importantly, kind of like unique AI applications. Those are things that like Venture Lab is involved with. So, I often help companies using both those hats as well. Sometimes when I can't, immediately work with a company using my fund, I'll often send them to, CDL, or send them to Venture Lab, as a starting point to get maybe a little bit further down the road, before we would engage. So those are tools that I use, kind of in my tool set, to some extent. But those are both fantastic organizations that I highly recommend people, look at and engage with.
Okay, thank you. So, headlines these days say that venture capital and unicorns and the thinking behind them are starting to change. Could you tell us a little bit about what it's like from the perspective of a venture capitalist? Like, what are some of the changes on the horizon?
So this is all true. So a couple things here. One is venture capital, it lives inside the capital stack. So, it's important to understand that because everything that happens around the capital stack affects venture capital. And so when you have a situation where, company growth or GDP growth in a country is fairly slow and stagnant, like it has been for many of the last kind of decade, um, when you have a situation where interest rates are quite low and the ability to generate a return, lending money to lenders, or just putting it in a GIC, is just not that great. And the stock market itself isn't really returning fantastic returns either. Like 10 to 15% a year on average, that kind of thing. Capital tends to start looking for higher risk, higher return opportunities to invest in, and venture capital goes into vogue. This is kind of more or less what's happened in the last 20 years of venture capital. It's really spurred on the venture capital industry. Um, Now, fast forward to right now, interest rates are higher. Inflation is higher. Um, it's really affected venture capital because, especially at the same time that interest rates were going up, the stock market was crashing. Stock returns were going down, which meant that the potential for an exit through an IPO or even an acquisition, if the companies that were going to acquire these technology startups were struggling themselves, these opportunities were becoming fewer and far in between. And so, because those things are happening, they've affected venture capital, regardless of what venture capital is done. So, like, it doesn't matter how fantastic the opportunities and technology companies might be, it's going to affect them. So that's been a huge slower of the momentum in the ecosystem for venture capital, over the last kind of 3 years. Um, 2021 was kind of like the peak. Everybody was going crazy. Everybody was investing. Valuations were going through the roof. I can talk about that a little bit as well. But like ultimately, when these things happened, when Silicon Valley Bank collapsed, when interest rates went up, when inflation started getting out of control, and the Fed started to move in to kind of try to control that, these things did end up pushing venture capital down as a priority in the capital stack. It also started creating a situation where investors were kind of needing to see more from venture capital. So at the same time, when the possibility of generating a huge return in the market from your investment strategies is diminishing, you have investors coming to you and saying, "Well, I can get 5-7% on a GIC. Why would I give you money so that you can hold it for 10 years and then come back to me in 10 years and tell me you got me a 15 to 20% return?" Like that's not that attractive. So it's kind of pushed the requirements on the venture capital as well to essentially do better at a time when it's actually harder to do better. And so this has kind of created a bit of a dynamic there. This, of course, trickles down to startups because if the venture capitalists don't have money to invest, they don't have startups that they can invest in. And so they have to become harder on the startups. The other thing to understand here is like, again, returns are quite simple. They're calculated as the money I put in today and the money that I got out in 5 to 7 years. And if the venture capitalists are expecting a 20 times return, well, that can be affected by two things: your growth and the valuation at the time that you exited, and your stage and the valuation at the time that I entered. And so this means that as a company, if I'm trying to go out there and get huge valuations on a pre-revenue company, or going out there and getting huge valuations on a company that has minimum revenue and hasn't quite achieved product market fit, but because they're looking at 2021 data and they're saying, well, this other company went and raised you know 10 million on a $50 million valuation with the same revenue and traction only 2 years ago. How come I can't get the same? Well, there's a really good reason for that. You can't get the same
Right.
because if I come in on those terms, now the expectation is that you have to now generate 20 times on that. And so like, I was having this conversation yesterday with the founder, and sometimes what founders miss is that like they think about valuation as a success metric, and it's not. Like this kind of became a thing in the last 10 years with companies like Tiger and Tiger Global, and then also like SoftBank coming in and almost like using capital as a moat, like saying like, if I get a company that has an interesting strategy and an interesting founder, and I give it unlimited amounts of money, billions of dollars, to capture the market, can it capture the market and then crush all the competition and then figure out profitability later? This is the Uber model, the WeWork model, etc.
Right.
That was a compelling strategy at the time because ultimately, what you were looking for as a venture capitalist was the return on investment. The return on investment is driven by valuation at each stage of investment and at the exit stage. And so, as long as everybody else is playing the same game, you can play that game. The problem happens that when things like the market correction happen, all of a sudden nobody's playing that game anymore, and now you're stuck with a bunch of companies with huge valuations and no realistic ability for the company to live and grow into those valuations. And so now you have a bunch of dead companies sitting in your portfolio that died virtually overnight. This is a huge problem for anybody who was investing heavily in that 2019 to 2021 period. And so like the appetite for doing those kinds of deals has gone down significantly. And what's happened in the last couple of years is an adjustment of the market where the venture capitalists were holding back capital, sometimes because they didn't have the capital to invest, or they were having to kind of slow down the pace of their investments because their investors were telling them to slow down the pace of their investments. In other cases, it was because the expectations of founders had just kind of been blown through the roof as a result of what happened in 2019 to 2021. And there was just no, to have a deal, you need a meeting of the minds. And if the founders over here and the VCs over here, you don't have a meeting of the minds. And so there's almost no point in having this conversation until the minds come a little bit closer together. And so now you're starting to see deals happening again because founders have realized, okay, like this isn't 2021. We need to adjust our expectations. So you're seeing a bunch of flat rounds. You're seeing even some down rounds, that kind of stuff. It's painful to go through, but again, like, the conversation I was having with this founder the other day is like, founders need to think about valuation not as a success metric. They need to think of it as an obligation. You now have an obligation to get to this point. So
Mhm.
if you say you have $1 million in revenue and I'm giving you a $10 million valuation today, that means that you have to live up to a $10 million valuation, which really means like your revenue has to kind of catch up. And on top of that, I want to see between now and the next round that you're going to go 3, 4 times beyond that by the time you get to the next round. So your valuation at the next round has to be 40 million or 50 million. It's an obligation. It's not a uh, a success metric. It's a vanity metric at best. And so, like, this is something that founders often miss.
That's a really interesting perspective. There's so many moving targets. It's hard enough just to have a good product, have a good team, be able to iterate with competition, line up your financing, not lose employees to other companies that have better offers. The customers can change. A pandemic can happen. There's so many like moving targets you have to hit. How much of this do you think is luck at the end of the day? Like 50% or more?
um, you know, Luck is a funny thing. I think there's a lot of luck in it, actually. But luck is something that happens to people who do the hard work to be ready when luck happens, right? Luck can happen to you and you're caught flat-footed, and you get the break, you get the customer, you get the introduction, you get
Right.
the product market fit, right? But then you didn't do the things that you needed to do to be ready when that happened, and now you're flat-footed and you've missed the opportunity, and you might as well go home, pack it up, and give up. So it's like it's one of those things, right? So luck has a huge amount to do with it. I think like most honest founders will tell you that they were lucky to get to where they got, if they had a successful exit. And many founders will sometimes lament the mistakes they made and say that they were unlucky if they failed. um, there are for sure founders out there that believe it's all them. Usually that's a red flag for investors. If like you're a founder and you're like, oh yeah, I'm just really smart and I did it all by myself, like reality is no, you didn't. Like you lived in an ecosystem, you had an environment around you that allowed you to get to the point you were. Even things as simple as like having venture capitalists that are willing to give you money, or angel investors that are willing to give you money, having access to talent. Those things don't just happen. There's infrastructure, there's an ecosystem that creates those things. Even like not having to worry about having your car stolen every day, or not having to worry about somebody coming into your house and trying to take your stuff. We take that for granted here. It is not something people take for granted in other markets. And so like these things contribute. At the end of the day, you have to just do your best to create the conditions for success. Do de-risk the things that you can de-risk, and then wait for your break. And do everything to make that break happen. Luck happens to those who work for it, right? So yes, it's luck for sure. It's a huge amount of luck, but it's like it only happens
But you
for the
also
people
make
that
your own
really
luck.
work. Yeah, you have to make your own luck.
Yeah, that's interesting. So, prediction. Do you think we will ever get back to a 2019, 2020 kind of rose colored glasses investment period? And do you think we even want to, given what you said?
I don't think it was a good thing. I don't think it was healthy. I think that we will go back up again, but it wasn't a healthy market. It was a bubble market, and I think in many ways we're still in a bubble market. In other ways, like there's still a debt bubble out there. There's still a real estate bubble out there. My personal opinion is that there still will be a lot of pain before we get back to kind of sunny ways kind of thing. And maybe I'm a bit pessimistic on that. Different people will have different opinions, but I think there's still a lot of bad that could happen. Yes, the government can do things to try to delay and postpone those things, but those issues are there and they're real issues. And so, will we get back to 2019, 2021 eventually? Hopefully by then, it makes more sense. But realistically speaking, I think that there's still a lot of pain to be had. There's still a lot of correction in the market to be realized. And we'll just have to kind of wait and see what that shapes up to. So, you can't control those factors. What you can control is what you do. So as a founder, do you have a compelling enough technology? Do you have a big enough market? Do you have a customer that wants your or needs your technology? Like not wants, needs it, right? Because if they need it, then like they're going to buy it even if it's a hard market, even if they're having to lay off 30% of their staff, they're going to take your product and they're going to buy it. And so if you have something like that, and you have the ability to grow it quickly, you can still be successful even in this market. And the nice thing about this market is like in a market like in 2021 or 2019, there was just so much money flowing around that there were so many companies out there that frankly had no business existing. People basically raising on a pitch deck, people raising on hype, going out there and just getting people to throw money at them. That causes a lot of noise in the market. If you're a startup with real tech and a real solution and product market fit, and you're having to compete with 10 other companies out there that are full of hype, marketing people that like, just flash and pizzazz, but it's all smoke and mirrors, it's really hard to compete, right? It just makes your ability to execute harder. And that can be a good thing, but like it's also a bad thing. And so when you have a situation like now where a bunch of those companies now, the rug's getting pulled out from underneath them, they're crashing, they're burning, they're going bankrupt. Your competitive landscape is consolidating. And now, if you have a real business with real revenue, a real product, and you're able to kind of survive through this period, the other side of this is really positive. Like you have an open field now to go and execute. And that's I think part of the reason why some of the most successful companies of today, like when we talk about Google and Amazon and all these things, they were born in the ashes of a bad cycle. Like 2001 spawned some of the most fantastic companies that we know today, right? Same thing with 2008 spawned some fantastic companies because they had that potential to kind of be part of that reset. And so, I think that it's an opportunity as much as it is difficult. And the people that approach it the right way have everything they need to be successful.
Wise words. What are a couple of the companies that you think venture capital worked really well for?
That's a good question, to be completely honest. I mean, like, honestly, I didn't come with a prepared answer. I can tell you a lot that it didn't work well for. There are some that are kind of TBD, like Uber, who just finally returned a profit this year or last year. But like, TBD if that'll actually survive. Um, you know, I don't, I can't say off the top of my head like these companies were. You know what? Old school. You can go to the old school, right? Intel, you know, um, Salesforce. These are fantastic companies that wouldn't have been possible without venture capital. Um, you know, you have companies like Tesla, which received quite a bit of angel venture capital and then private money, and has been doing fantastically well despite a lot of naysayers. Essentially revolutionized the entire market. SpaceX for sure, but that was more private equity than venture capital, I think. So these are there are definitely companies where there's alignment, right? And I think that's the key thing is like, is there alignment between what the venture capitalists want and what the company wants? Is this a real business and a real market with the ability to generate revenues and profits? If it's not, then it's not going to work. Sooner or later, it's going to fall apart. I don't want to name names in terms of companies that are not successful because I think there's a lot of examples out there right now of companies that are really struggling because they did go that route. Yeah, like there's a lot of companies that venture capital worked for fantastically. And then there's others that like it didn't work for, like OpenAI, right? Like if we really look at that, that was kind of angel backed. It was like Elon, a lot of it for a long time, and then it was like a few other people, and then it was Microsoft just like plowed in money. But that's not a venture capital deal, right? But look at how successful they've been, right? Even in Canada, we have our own examples of that, where like Daya Foods, for example, is one that I love to kind of bring up because the venture capitalists couldn't invest in them. A venture capitalist did invest in them personally because they really believed in it. and got a fantastic return. The company had a huge exit, and it grew fast, but it didn't follow the venture capital pathway because it couldn't. It wasn't a fit. But they still grew a fantastic business and had a fantastic exit as a result of like going and finding alignment with the investors that they did need, and then growing a business sustainably and going the other route. So it's not to say that like venture capital is the only way, right?
Yeah, well, thank you so much for all this perspective. There's a lot to consider, a lot of hope, a lot of measured optimism, I suppose. Where would you like to direct people? Like, should they check out CDL, or is there anything that they anywhere they can follow you?
Yeah, so Creative Destruction Lab for sure. Check that out. They might, depending on where you are based, they might have a chapter in your home city, so check it out. The other one would be Venture Lab. If you are looking to come, if you're in North America, especially if you're in Ontario, but anywhere in Canada, you can access Venture Lab. Actually, some people don't realize that. If you're a company from a foreign market looking to land in Canada, but you're not necessarily, even if you are looking to move entirely, but even if you're not, Venture Lab has programming for those kinds of companies. And then, of course, our website is canada.bc. If you think you could be a fit for our thesis, welcome to, we do take applications on our website, and we're always happy to meet new companies and talk to them. And I'm always personally happy to connect with companies on LinkedIn that could be a fit. Give them some feedback. Happy to do that. And then often, like we do a lot of work connecting with other VCs in emerging markets, especially the ones where we see potential. So we're always happy to connect with other peers in other markets and collaborate with them on bringing companies that could be a fit to North America. So I guess those would be the things.
Great. Well, thank you, Yuri, for talking with us today. It's really interesting.